Welcome, everyone, to the I can't believe it's already February monthly strategy update. Just a little humor. Just seems like last week when we were sending out the year-end, letter and talking about 2024, and here we are already a week into it. But we've had a big rally over the last 60 days in both stocks and bonds, and as we've said in the past, pullbacks are normal, even though again the markets are up so far today. Sizable amounts. So everybody just kind of take a breath. Nobody panic. We know the tech is working. We know the bonds are not. Then you throw in an election year, and we'll see if Jim can maybe address some of those things today. But before I turn it over, my name is Keith Duran. I'm the Senior Vice President of Business Development for the company. And we're joined today, as always, by Jim Warner, Head of Research and Co-Portfolio Manager. We'd like to thank everyone who's on the call for taking time out of your day. As you know, these are not long presentations, but are designed to help you understand why we are invested where we are and our thinking behind it. However, we encourage lots of questions. So as a reminder, you can use the Q&A button at the bottom of the screen as we go along, and we'll address them at the end. So without further delay, Jim.
All right, great. Thanks, Keith. And thanks to all of you who have taken some time out of your day to join us on another market strategy update. So this month we've entitled the presentation "Calibrating Fed Reality: No March Rate Cut," and that's really what the market's doing. The market is basically right now. The focus of the market is when is the Fed going to start cutting rates? And what we experienced during November and December in that really huge Santa rally was really a shift in market sentiment from when is the recession to, well, there might not be a recession. And that's really what's powered a lot of it. As we've gotten into January and February, there's been a little bit of a pullback across a lot of stocks, which is normal after any sort of big rip in the market. We've also seen that in bonds too, as basically the market tries to recalibrate or calibrate where interest rates need to be. And what's been really interesting about the last few weeks is just how dominated really what's powered the equity indices has been really NVIDIA and Meta. It's been a pretty wild, the kind of narrowness that we've seen in the market. But as you can see, the markets are still up for the year. The equal weight, which we've talked about in the past, is pretty flattish. So it gives you a sense for how kind of the Magnificent Seven are still really powering this market. And then on the bottom right, as Keith alluded to, we've had just a little bit of a pullback in the bond index. It doesn't change our bullishness on bonds for the year, but that's normal as interest rates have kind of yields have basically gone back up a little bit after what was probably an overcooked market heading into this year. So what's driving this market? As I mentioned, it's this debate or this calibration over when and by how much the Fed will cut rates. And so as you can see in this graph, we entered the year in the dark blue bars, with an expectation that there were going to be a significant number of rate cuts, and they would most likely begin in May. Well, a lot of what we've heard from Fed speak and that sort of thing, and we've had sort of a bullish payroll number, and there's been some other macro data points that have been a little bit more on the bullish side. The market's had to recalibrate what we already thought was kind of an overexcited view on rate cuts. And so you can see in the light blue bar that where we sit basically today is the market's kind of reset for higher interest rates and fewer Fed cuts. But that's really what's moving the market on a day-to-day basis. And of course, this is a little bit better tracks the higher for longer talking points that we've heard from the Fed now for quite some time. And so we're kind of in a better position, I would say, in terms of where rates are, and so the market can move forward from here. Now, of course, the keys to forecasting the rate cuts really continue to hinge on two major data points, which is the core PCE, the Fed's favorite gauge for inflation, and non-farm payrolls. What we can say is that inflation continues to head down, and we've noted in the past that housing continues to prop up this number. We think the actual inflation rate is a lot lower, and I'm going to get to that in a second. And meanwhile, and so that's good. That's good in the eyes of the Fed. That contributes that supports essentially the Fed pivoting to rate cuts sooner rather than later. On the other hand, payrolls have remained solid. And, remember, the Fed has a dual mandate. It's to get inflation back to 2%, and it's to have a full employment in the economy. And we're basically at full. And in their view, there needs to be some softening of that in order to really justify rate cuts. I'd argue that there is some softening going on. We'll get to that in a minute, but we can actually still get inflation down to an acceptable level without huge amounts of layoffs. And this gets us to really the thing that kind of keeps us up at night. And I'm going to spend a few slides on this in a bit about the biggest risk this year and for the markets is that the Fed waits too long to cut rates. So as you know, if you've listened to these in the past, our favorite inflation measurement is a real-time measurement from a company called Trueflation. And they have data feeds from millions of different sources across that cover every sector of the economy. And this, we think, is a much better and accurate read of where inflation is today. As you can see from the chart, their inflation gauge is now down to just 1.34%. Now, that is way below the Fed's 2% target. So in our minds, the Fed needs to start cutting now. There's also another way to look at this is what's really driving the deflation that we're starting to see, or disinflation at least. And it's easy to think about this in two ways. There was a phase one of disinflation, which is now complete. This was basically the stimulus money was spent, the economy fully reopened, and hence the spending mix between goods and services has normalized. So we don't have that concentration of spending just on goods right now, driving goods prices higher. We also don't have a lockdown economy that's driving wages higher because people can't get off their sofas. So there's a bunch of things that needed to happen, and that was something that really occurred about 18 months ago. What's ongoing right now is the economy digesting higher interest rates and, yes, elevated prices. So while we see some prices coming down, they really just kind of stair-stepped up about 20%. And, we're kind of, essentially have hit a plateau. So as you all know, I mean, menu prices at restaurants, they've gone up and they haven't gone back down. So you can sort of see how this is flowing through the economy. But this is also, benefiting from the higher interest rates. And as you can see from this graph below, what I mapped out here was the core PCE inflation rate, which is this lighter blue line. You can see it's arcing down. Some of that is because phase one is complete. And some of that we're just starting to see is from the higher interest rates. And that's this darker line. So this is the Fed funds rate, which was basically zero until about April, May of 22, and you've seen this big, very aggressive raise that we've talked about in the past. Now, if you look at historically, what the relationship has been between core PCE and the Fed funds rate, this is a very interesting relationship. So as you can see, going back, and we went back here to January of 1999, right before the dot-com bubble burst. But effectively, right before the dot-com bubble burst, you had essentially a very high Fed funds rate relative to inflation. Now, when this happens, as it happened right before the housing bubble, oftentimes a recession follows, where basically the Fed has to dramatically cut rates, and you start to see that relationship compress. You can see what's happened more recently is when we had record inflation, right? You had very high core PCE and still a Fed funds rate that was near zero. So obviously this was a very accommodative policy, and that needed to be tightened. And so you see with these rate cuts going up and core inflation going down in recent months, that we've now gotten back to a fairly restrictive relationship between Fed funds and core PCE. And if this continues for too long, I'm afraid that it will start to strangle the economy. So this is another, and it'll burst another bubble. One of the bubbles, for example, that we've talked about that we think is going to burst is the real estate pricing bubble. And that is something that will play out over the course of probably the spring selling season. That's in the next few months, and something that we're keeping a very close eye on. But this is very important, this relationship. And so in our minds right now, the next 6 months or so, this is your potential market scenario. For now, we think the market may keep rallying. The equity market may keep rallying, although historically February is not a very good month. But basically, what's driving this is now this narrative that we're going to have a soft landing, and rates are going to head lower because inflation's heading lower. Now, we think in the meantime also that the labor market will still remain fairly strong, but we do expect increasing layoffs. And just in the last, week, we've seen almost upwards of 50,000 jobs laid off in the tech sector alone. Now, you may have noticed just a couple slides earlier that payrolls came out to be over 300,000 in January. It's very important to understand that that is basically a survey that is done in the second week of January. So it doesn't capture some of the layoff notices that we've seen in the last few weeks. So I think that's coming. Now, that being said, we don't see an enormous surge of job losses. We think this is more driven by the higher interest rates pinching corporate profits, and therefore it's driving companies to kind of trim excess staff. So that's where we think we are, at least for the next, few months. But by summer, we think the narrative may change, and we might start talking a lot more about deflation. And, like a lot of times, we may be early on this call. Nobody's really talking about this except us, and maybe a couple of other independent researchers that I've found. But basically, the whole thesis here is that housing prices are declining, and they just haven't flowed through core PCE yet, and they will. That's just a matter of time, and that's going to drag down core PCE a bit, and then we might start talking about deflation. So, what will that mean? This will prompt, rate cuts from the Fed for sure, and we think that the first one might be as much as 50 basis points. Now, it kind of depends on when they do it, but if we get into the summer months and this is actually happening, you're going to see some big chunks taken out of the Fed funds rate. Now, this isn't all bad because this is really great scenario for bonds. So as lower, those rate cuts happen and we get lower rates, the bonds actually should perform fairly well. Now, our biggest question and the most important question for 2024 is, will the Fed wait too long to do this and really tank the economy in the process? That's kind of our biggest, that's the thing that sort of keeps us up at night. The other reason why cutting rates sooner rather than later is important is because there's a wall of corporate debt coming due. So, obviously, if rates get cut, this will help with the new coupon and new interest expense as businesses refinance. But as you can see, there's a huge step up that's going to occur. So if we look at this graph on the lower left, the gold bar is actually, we'll focus on the gold bar because these are the speculative grade or the junk bond rated companies. And as you can see, that there was only about $100 billion of maturities that came due last year. That steps up to about 250 billion this year, which steps up to another almost 400 billion next year. And of course, we got even higher ones in 26 and 27. So it's really material because, when you obviously are exchanging in many cases a bond that had, a 5% coupon for a 9% coupon, that's going to dramatically impact your bottom line. And so, this is the sort of thing that could lead to more layoffs, and ultimately, more bankruptcies as well. So we're watching that very carefully. But apparently, the market's not very worried about this. As you can look at the graph on the right, this is sort of the index for credit default swaps, which is essentially insurance for the credit risk on a bond. And when it goes higher, it means that people are more worried about defaults. And as you can see from this chart, it's kind of bottomed out here, fairly low levels. So we're watching kind of to see when the market figures this out, but it's going to be very important that the Fed starts to cut at some point, or we could have some bigger issues to deal with. And so the way we like to think about this is that the Fed is basically walking on a tightrope. And thanks to AI, we generated this fun little picture of Jerome Powell walking on a tightrope. And the key here really is just if they wait too long to cut rates, then the economy is going to have a problem. And unfortunately, there's no history of the Fed actually ever getting this right. And so if you look back historically, the Fed's always late to cut rates. They have to cut rates in giant chunks in order to respond to either a crisis that occurs or other types of weakness in the economy. We're not suggesting that there's going to be a crisis, but we are suggesting that I wouldn't rely on the Fed to get this right. But what gives me hope is that this is an election year, and there's going to be a lot of political pressure on the Fed to cut rates from the administration. So, we can look to that as a potential. I know they're supposed to be politically independent, but by all regards and previous actions, it's pretty clear they're not. But this is going to create uncertainty, is the point. And this uncertainty means that client portfolios need to also walk a tightrope. And so what does that mean, and how do we do that? That means we need to own a lot of bonds. We need to own businesses with durable earnings power. And we need to barbell this with growth and technology so that as this market rallies, we don't get left behind. But it is important, though, I think, to always be prepared and to be positioned, for, essentially the scenario that you think is most likely to play out. So in reference to that directly, this is the Global Vigilance, our flagship strategy portfolio. It's sort of in images on the right-hand side here. We'll send out this presentation as we always do, so you can go through it. But, we are very focused on really important themes that are driving the economy, like, growing electrification and the build out of an energy infrastructure, obviously artificial intelligence and digital transformation, which is happening across the economy, to defense, to medical devices, to Japan. So specifically, what we've done in the last month or so is we have, in light of our sort of slightly more negative view on the economy, we've trimmed commodity exposure. We've also reduced our mortgage REIT exposure, largely because it was fairly large and we had a nice run into the last couple months of the year. So this allowed us to diversify a little bit more into investment grade corporate and other kind of total return funds. We've also shifted a bit out of just pure tech index exposure and into specific names like CyberArk and Snowflake. Snowflake in particular is a very interesting company that I'll get to in a second, but basically benefits hugely from the AI surge and the surge in demand that's creating for cloud computing. And so that's a really exciting area, and it's a stock that really hasn't run up as much as, say, an NVIDIA. And then we also added to the Japanese index exposure. And as I mentioned, I think on prior calls, we're growing increasingly confident in, number one, the Japanese economy, number two, the Japanese central bank moving off of a negative interest rate policy. And what that in turn will do is that will increase interest rates somewhat. And that should also allow the yen to rally. And so the yen has been very depressed relative to the dollar for quite some time. And we think that there's kind of there's a very positive set of catalysts that are coming around Japan. And, the other good thing about Japan is that it gives us more diversification away from the US and all the various things that are going on. Our equity allocation throughout these changes have basically remained about the same, about 55 to 60%. Now, that's for Global Vigilance. It's as most of you know, it's a balanced kind of strategy for moderate risk investors. We, of course, have a conservative version of this. We have an aggressive version of this. And we've got other models that we're also happy to talk to you about that all are generally tactical, but also provide different levels of concentration risk. And risk, flavors. So what are we spending time on right now, other than watching the Fed? One place in particular that we're really spending a lot of time is on what I'll call fringe AI or fringe artificial intelligence. As you know, AI is a wildly popular theme. I mean, on Microsoft's earnings call the other day, they mentioned it 81 times. So clearly, this is a big deal, and it's probably a step function change for the economy, and you need to be there. There's a lot of stocks that have already moved very dramatically off the backs of that, but there's also a number of stocks that haven't, that are very much exposed to it. I mentioned Snowflake as an example. So there's a lot more out there, and so we're spending a lot of time digging through essentially these fringe AI companies. We're also spending a lot of time on misunderstood value. These, value stocks have really underperformed over the last few years, and they got a nice bid into year end, and they've lost a little bit of momentum here in the last few weeks. But there's a lot of very cheap stocks that are excellent companies. They tend to be in maybe a little bit more cyclical industries, but even like Kenvue, which we have in the portfolio, which is a consumer staple. These are the guys that make Band-Aids, right? Very solid businesses trading at incredibly cheap valuations. There's still lots of stuff to dig through in the market there that's very, very attractive. Of course, we're looking at idiosyncratic ideas. I think the best example of that is our medical device exposure. All of these device manufacturers got hit very hard. When the diabetes drugs turned out to be, the Ozempics of the world turned out to be, effective at weight loss, the stocks and medical devices went down on the assumption that nobody would ever need a knee replacement or things like that, which we think is silly. And we've had actually a nice little bounce in that. And as I mentioned on the prior slide, we're looking abroad more and more. India and Japan are our favorite places right now, but we're also doing a lot of work on Brazil and seeing if there's another way to diversify our portfolio away from the US. And then we're also thinking about election what-if scenarios. As Keith mentioned in his intro, we're getting a lot of questions about, well, what does it mean if, a Republican gets elected or a Democrat? Basically, we've gone back and done this analysis, and aside from George W. Bush, who lived through there was the global financial crisis and whatnot, it doesn't really matter what happens to the market. The market basically looks through and is more interested in the market cycle than it is specifically on who wins the election. But sector opportunities do exist. For example, I put this betting data on the side here, and basically, what the bettors have now have Trump winning. Let's just say for the sake of argument that happens. Is there going to be a shift from emphasis on clean energy to more traditional oil and gas? There is a thesis and a scenario where you might really want to own energy companies if you think Trump's going to win. So that's important to think about. Trump's also talked about having 60% import tariffs on China and 10% import tariffs on the rest of the world. That's going to have some implications. And could there also be accelerated onshoring? So there's a lot more questions and answers at this point, but this is the kind of thing that we're kind of digging through to see if, as we get closer to November, if there's an interesting trade to put on there. And, of course, you also have to remember that campaign promises are just that, and they're very different than actionable ideas. But every once in a while, you can actually find a really interesting theme, in a particular sector. So what I'm going to do is stop there and take questions. Keith, if you'd like to moderate that would be great.
Absolutely. So the first question says, has the January PCE been released yet? And if so, what was it?
I haven't seen it yet.
Okay.
Well, actually, that's not true. Let's see. Let's go back to the chart. All the way back to the beginning. So, yeah, we're going to get it in a little bit. I can't remember exactly what day it's going to come out this month, but we don't have it yet. I expect that it's going to be lower than 2.9%, but we'll just have to wait and see.
Okay. The next one, understanding the short end of the curve is too high. Do you think the 10-year is already fully priced in the rate cutting cycle? In other words, I guess, is the opportunity for bonds really just at the short end? It seems like the 10-year at about 4% is a normal spread to the future Fed funds rate projected by the Fed. That is 2.5% to a 1.5% spread of the future Fed funds rate.
Okay. Well, let me take that in pieces. It's a great question. So well, So if you think that the short end of the curve is too high, well, first of all, let's pull up where the curve is today. Okay, so all right, so here's your problem. If you own a money market, let's just start with an extreme example, right? That's basically where Fed funds rate is today. You're going to get paid less over the course of the next 6 months. If that were a bond, because of course you can't break the buck on a money market, but let's just say you had like a 30-day T-bill. You're going to have to wait for maturity because that bond will actually lose value if there are rate cuts within the 30-day window, right? So I don't think where you want to be is on the short end of the curve at all. I think where you want to be is at the longer end of the curve. Do I think that the long end of the curve is fully adjusted for where, kind of a 2% target? No, not really. I think that we're going to see the long end of the curve decline somewhat. And you're going to see that happen probably before the Fed actually starts cutting at the front end. So you're right to say that, the long end of the curve is less sensitive to the Fed, but, bond math dictates ultimately, that those Fed fund, that this curve is what's actually getting priced in. I mean, you can see that, the market is running out their assumptions. And I think that right now, like the inflation assumption for the 10-year is roughly in the 2.5% range. And that to me is too high. I think we're going to see a lot lower get priced in over time. I don't think we're necessarily going back to a 2% 10-year unless we have a really big issue with deflation. But I think it's going to go lower than here. I think, a good target probably for the next, 6 to 9 months is probably, maybe 3.5, 3.25. So, again, supportive for our bond thesis. But that's how we read it.
Thanks, Jim.
And follow up if I didn't answer your question fully.
Well, my comment would be, you can always reach out to us, offline after the webinar, and we'd be more than happy to answer it, more in depthly. Another question is, are you concerned that ongoing fiscal deficits will fuel future inflation?
Well, so there's a lot of talk about deficits, and obviously they're too high and they're a problem and they need to get fixed. One thing, though, that is important to understand is that in some ways I like to, I guess that's not a really politically correct term, but we're the smartest small person in the room. And when you look at other economies, I mean, would you rather have a 4% 10-year treasury or a 1% JGB? Would you rather have a 10%, and a 1/4% 10-year or a 2% German Bund, or a 2% Italian bond? In many ways, where we're priced on a relative basis in treasuries right now is extremely attractive. And so I don't really see any near-term issues with being able to raise bonds and be able to support the debt. But yeah, it's a real concern what's going to happen. I mean, if we actually had adults in charge in Washington, D.C., you would see people starting to tighten the budget belt. You'd see probably higher taxes. You'd see, some effort to, really work down this inflation. Because ultimately, if it work down the deficit, ultimately, that actually is going to put economic constraints. And so I don't necessarily see. So if we actually really seriously start to deal with deficits, we're actually going to see, downward pressure on inflation. And I, find it, though, a bit hard to believe that we're going to continue to spend at the rate that we've been spending for the last, really call it 4 years. So I don't know. It's something that obviously we consider, we think about. It's not really super relevant to the way we're managing the portfolio right now. But yeah, I mean, this is obviously, longer term, a very important issue to keep an eye on.
Okie doke. Can say again?
Any more questions?
Okay. It doesn't look like it. So with that said, again, thank you, everyone. Please reach out to us offline. Jim, thank you very much. As always, this information is always it's always great and enlightening. But anyway, we'll catch you again next month, and thank you again for joining.
Thanks, everyone.